Welcome to video 3 of part 1 of the EA Tax Training free EA exam prep course for 2025. Tom here back with you to discuss capital gains. There's a lot of technical material in this video, and some of the concepts will also be applicable in part 2, business taxation. So watch it as many times as you need to and study the slides in the free resources. Specifically, what we will cover in this video are types of property in the tax law, basis of assets, capital gains and losses, and non-taxable and other sales. Our free resources from irs.gov, the first two there you will recognize from the other videos. I'm sure you've already got those and are studying those. And then for this video in particular, we've got Schedule D and Form 8949 and their instructions. That is where capital gains and losses will be reported. So you will want to be familiar with those. We'll have a look at those in this video, but you will want to have your own copy and read through those and through the instructions. And then also Publication 544, Sales and Other Dispositions of Assets. I'd recommend you get that one as well. And then these other items you can get if you are interested in those particular topics. Our flow of the tax return, we are still up here at the very top. Gross income, capital gains are another type of income that is included in gross income. So let's talk first about different types of property. As you're reading the tax law and as you're reading the various publications and forms, you will see different types of property mentioned. And so you want to be able to understand what the IRS means when they're talking about each of those types of property. So here are some of the categories you'll see. First of all, you'll see investment property, and that's simply property that produces investment income. So it's things like stocks, bonds, treasury bills, and notes. Next, you'll see business property, which just means property that is used in a trade or business. Could be buildings, computers, equipment, trucks, etc. Next is tangible versus intangible property. So tangible property means it's physical in nature, that you can touch it. And intangible property is the opposite. It's not physical in nature. You can't reach out and touch it. So it's things like computer software, patents, trademarks, licenses, customer lists, etc. So for example, if you have a computer, that is physical in nature. So the computer itself is tangible property. But then if you install software on that computer, the software would be considered intangible property. So that's one example of the difference. Another type of property is depreciable property. This is really a business concept. So we're going to go into it in detail in part 2, but you do want to at least be familiar with it for part 1 because there are some times when depreciation comes up, when something called depreciation recapture comes up. So what depreciation is that a business, or if you've got a rental property, when you buy assets to use in your business, you are allowed to deduct the cost of those assets. But usually you don't deduct them all in the year that you buy them. Instead, you deduct the cost of it over the expected useful life of that item. You deduct a little bit each year of the cost of that. So that's what depreciation is doing. So some examples of items that would be depreciated are buildings, machinery, equipment, computers, vehicles, etc. One big exception to this is land. Land is not depreciable because it's not considered to wear out over time. Yes, you can have erosion and those types of things, but as far as the tax law is concerned, the land is never going to wear out. And so therefore, we are not going to depreciate the land, but other business property we can depreciate. The next distinction, and this is a very important one, is real property versus personal property. These are very old terms, and real property means land, buildings, and equipment and fixtures that are attached to land or buildings. So building systems such as heating and air conditioning units, plumbing, etc. It's built into the building. It's considered part of the real property. So think of real estate. That is real property, land and buildings. And then personal property is everything else. Or another way to think of it is property that can be moved. You can pick it up and move it. Personal here doesn't mean that it's not used in a business. It's not personal in that sense. Again, personal just means that it's not real property or that it's property that you can move. So you have personal property that is used in businesses all the time. Computers are personal property. Desks and chairs are personal property. Even vehicles are personal property. So all of those things are considered personal property in the tax law. Then we've got capital versus non-capital assets. Of course, this video is about capital gains, so we need to understand what we're talking about. So non-capital assets, these are specific categories of assets that when those assets are sold, they do not result in a capital gain or loss. There is this list of items that are not considered to be capital assets. And so those are non-capital assets. So if those are sold or otherwise disposed of, the gain or the loss on the sale of that asset is an ordinary gain, meaning it's taxed at all the same regular ordinary tax rates that other income is taxed. So you've got your salary income and interest income. That's all taxed at the normal, quote unquote, ordinary tax rates. As opposed to that are capital assets. So capital assets is any asset that's not on that list. So if it's not considered to be non-capital, then it is a capital asset. And when that is sold, then it results in a capital gain or loss. And capital gains, or something called long-term capital gains, are taxed at favorable capital gains tax rates. They are lower tax rates than ordinary tax rates. And because of that, we usually, as taxpayers, would like to have capital gains because capital gains are taxed at lower tax rates. So taxpayers generally prefer capital gains. However, if you have a loss when you sell or dispose of a capital asset, then those losses are limited. Whereas if you had an ordinary loss, those losses are not limited. And again, we're talking here about investment property. If you've got a loss on a personal asset that you just own and use in your daily life, you don't get to take a loss for that regardless. But if you're talking about an investment asset, if you sell that asset and it is a capital asset, then the amount of losses that you can take is limited. Whereas if you sell that asset and it is an ordinary asset, then those losses are not limited. So taxpayers generally prefer ordinary losses. So we like capital gains, especially long-term capital gains, and we like ordinary losses. So we want to keep that in mind as we go through this course, and we'll talk about all the specifics of that as we go along here. So what is this list of items that are not considered to be capital assets? Well, here it is. It's on your screen. First of all, any property that is held for sale to customers, otherwise known as inventory, not a capital asset. Secondly, depreciable property used in a trade or business, not capital. Real property used in a trade or business. And the reason that's separated is because, remember, land is a type of real property and it is not depreciable. So it would not automatically be included in the prior category of depreciable property used in a trade or business. So it's separated out. So whether it is depreciable property or real property, if it's used in a trade or business, not a capital asset. Next is intellectual property that is held by the person who created it or who received it, such as by inheritance or by a gift. So, for example, if you are an author and you have written a book and you have a copyright on that, you are the one who wrote the book. So in your hands, that copyright is not a capital asset. Same way with a songwriter or an inventor who has a patent on something. Those copyrights and patents are not capital assets if they are owned by the person who created them, or if that person then gives them to someone else, then that person does not get to treat them as capital assets either. Next are accounts receivable in business. So that's amounts that customers owe to the business, not capital assets. Certain U.S. government publications. This is kind of the oddball on the list. You don't need to worry about which U.S. government publications. Just know that there are these certain U.S. government publications that are not considered to be capital assets. Certain commodities, derivative instruments held by dealers, not capital assets. So dealers, as we'll learn later, they hold investments for resale to others, to their customers. So it's kind of like inventory. It's an inventory of assets that you have, and it is not a capital asset. Hedging transactions, this is another investment concept. So if you have hedging transactions, they are not a capital asset. And then supplies used in a trade or business, not a capital asset. So what this means is that most of the assets that are owned in the world are capital assets. So everything you own as an individual is a capital asset. So that includes your home, your cars, your furniture, your clothing, your investments. Anything like that is considered to be a capital asset. So you can see, if you think about it, most of the things that are out there in the world are not on that list of things that are not capital assets. Therefore, they are capital assets. The other kind of interesting thing to note is that it's more about how the asset is used rather than the type of asset. So if we look at this list again, you've got depreciable property used in a trade or business. So if a business owns, for instance, a car, that is depreciable property used in that trade or business. So that is not a capital asset. But if you or I own a car just in our personal lives that we drive around, that same car is a capital asset. So it's not the fact that it's a car that determines whether or not it's a capital asset. It is how that car is used, whether or not it is used in a business. And you can see that most of the things on this list really have to do with using it in a business. So property held for resale to customers, that's business. Depreciable and real property used in a business. Even this, the intellectual property that's held by the person who created it. They're in the business of writing or writing songs or inventing. So not a capital asset. Accounts receivable in a business. The government publications is kind of an odd duck, so we'll skip over that one. But these commodities here, they're held by dealers who are in the business of dealing in investments. So not a capital asset. Hedging transactions is, again, a little bit of an oddball, but it's an investment type of concept, not a capital asset. And then, of course, supplies used in a trade or business. So it's kind of the common theme here is that it are items that are used in business that are not considered to be a capital asset. So now let's talk about the basis of assets. We talked a little bit about basis in a previous video, but the basis of the assets is sometimes also called the cost basis. So at its most basic incarnation, the basis is simply the cost of that asset. So what do we need to know this basis for? Well, it helps us to determine a gain or loss when that asset is sold. So if we sell an asset, we need to know, did we have taxable income? Did we have a taxable gain on the sale of that asset? Well, in order to determine that, we need to know its basis. It also helps us to determine depreciation. So when businesses have assets that can be depreciated, they depreciate that asset based on its basis. So we need to know that. We also need to know the basis to determine the amount to put on a business's balance sheet. So we'll find out in part two that businesses list all of their assets on something called the balance sheet. And we use the basis in order to determine that amount that goes on that balance sheet. And then there are other miscellaneous uses that we'll see. Sometimes the tax law will refer to the basis of an asset, for example, in order to make a determination about a rule. So we need to know the basis for those reasons as well. So let's talk first about determining the gain or loss on the sale. So in theory, it's a pretty simple concept. In order to determine a gain or loss, you simply subtract your basis in the asset from the sales price. And in the simplest cases, the basis is equal to the cost, how much you paid for the asset. So for example, you bought 20 shares of stock in XYZ Corporation for $500 or $25 per share on June 1st of 2022. On June 1st of 2024, you sold 10 of those shares for $300 or $30 per share. You have a long-term capital gain of $50. So 10 shares at $5 per share. You bought them for $25 per share, sold them for $30 per share. That's a $5 gain. There were 10 shares that were sold, so you have a $50 gain. So that's a simple example of determining gain or loss. When we talk about the cost of an asset, the cost includes not just the stated sales price of the item, it also includes the expenses of the sale, such as commissions, fees, closing costs, sales tax, anything that is part of purchasing that asset, any extra costs that you pay are included in the basis. So, for example, you buy 100 shares of stock in XYZ Corporation at $10 per share. You incur brokerage fees of $20. Your basis in that stock is $1,020 or $10.20 per share. So when we used the example on the previous slide, we just kind of pretended that you paid $10 for the stock and that was the end of it. But in the real world, if you're going to go out and buy some shares of stock, you're not going to get it just for whatever the stated price is. You're going to have to pay some sort of fees that go along with that. And so you add those fees in order to determine the basis of that asset. So the second example there is you buy a car for $30,000. You pay sales tax of $2,400, a delivery fee of $400, and a dealer administrative fee of $200. Your basis in the car is $33,000. So even though you look at the sticker and it says $30,000, your basis is actually $33,000. When we are dealing with real properties or real estate, then the basis is almost always going to include costs other than just the purchase price. And those costs can largely be found on the closing statement. So if you've ever bought any real estate, like you bought a house, then you'll know what I'm talking about here. You get this closing statement. It's got all these different fees and costs that are included in it. So you've got things like recording fees and appraisal fees, abstract fees, survey costs, title insurance, etc. Those would all be included in the basis of that real estate. One thing you do not include, though, are loan fees and points. So you may have borrowed money in order to purchase this real estate, and you may have to pay loan fees or points when you get that loan. But the loan is a separate thing from the property. So we do not include those loan fees and points in the basis of the property itself. Also, when we're dealing with real property, if we are constructing that property rather than buying it, then all the expenses of construction are included in the basis, including the materials, the labor, any permit fees or inspection fees that you get, etc. All of that included in the basis. And if you have to do demolition prior to building the building, those demolition costs are added to the basis of the land rather than the basis of the building. And the reason that's important is because if this is business or investment type of property, remember, we can depreciate the building. You cannot depreciate the land. So if we had our druthers, we would rather have those demolition costs added to the basis of the building, because the building we're going to be able to depreciate and deduct over time, whereas the land we are not. However, we don't have our druthers. We don't get to just decide. If we have those demolition costs, they are added to the basis of the land rather than the basis of the building. So you will want to remember that. Basis increase after purchase. So for any type of asset, it is possible to have an increase in basis after we purchase it. This is much more common, though, with real property. So if you make major improvements or additions to the property, then your basis increases by the cost of those improvements or additions. So if you add on a room to a house, for instance, or you add a driveway or a fence, landscaping, flooring, major systems, a new air conditioning system, something like that, those things get added to the basis of the property, but you don't add things like repairs to those items. So if you are fixing a pothole in the driveway, that's a repair. You don't add that to the basis. But if you're adding a whole new driveway, then you would add that to the basis. Or if you are repairing the air conditioner, that's not added to the basis, but adding a new air conditioner is. So these are maintenance items. They do not get added. So that's such as painting, fixing leaks, filling holes or cracks, replacing broken hardware, etc., not added to the basis of those items. It is also possible to have a basis decrease after purchase. So the most common one for business type property is depreciation expense. Again, our personal assets, your personal house, your car, if you don't use those things at all for business, you're not allowed to take depreciation. So this is mostly a part two concept, except again, we do need to have a basic understanding of it for part one. But depreciation expense that you take on your taxes does decrease your basis, and any other expenses you take related to that asset on your taxes would also decrease the basis. So if you got a casualty loss on an asset, which that could happen on a personal non-business asset, that would decrease the basis of that asset. Or if you get a rebate on something that you purchase, that decreases the basis. So you originally paid $1,000 for an item, but then you later got a rebate of $100. Well, now your basis, instead of being $1,000, is only $900 in that example. And then any money that you receive to reimburse for a loss. So if you got hail damage on your vehicle, the insurance company sent you a check for that, that would decrease the basis of that vehicle. So those are some examples of how you can decrease the basis of an asset after the purchase. Stock, dividends, and splits. A lot of the basis and capital gains issues that you will deal with for part one for individual taxation are going to have to do with investment type of assets like stocks and bonds and mutual funds. So when we talk about stocks, you can have stock dividends and splits. So remember, we talked about stock dividends previously. Stock dividends and stock splits are usually not taxable income, but they do change your basis in the asset. So to determine the basis in each share of stock after you've had a stock dividend or a stock split, you take your basis in the original shares and you divide by the new number of shares. So let's look at an example. Terrence bought 100 shares of BCD Corp for $1,000, making his basis $10 per share. BCD Corp issued a stock dividend of 2/10 of a share per share. So Terrence now owns 120 shares. So remember, he does not have to pay tax on that stock dividend. So he got 20 extra shares that they just gave to him as a dividend. No taxable income on that. But now his basis in those shares is only $8.33 per share because he's got more shares than he had before. So he's still got his same $1,000 basis overall in his shares. But if you look at that on a per share basis, instead of being $10 per share, his basis is now $8.33. Example 2. Sandra bought 100 shares of XYZ Corp for $1,000, making her basis $10 per share. Later, XYZ Corp announced a stock split of 3-1. So Sandra now owns 300 shares. So her basis in the shares is her same $1,000. That hasn't changed. She still invested $1,000 in her shares, but now she owns 300 shares. So her basis per share is $3.33. And sometimes a corporation will do a stock split to try to reduce the price per share of their stock in order to make it easier for investors to buy that stock by lowering the price per share. So if they do that, this is how you handle the basis. Non-dividend distributions. So sometimes a corporation will make a distribution to their shareholders that is not considered a dividend. And you'll often see this on a 1099 div. If it is a non-dividend distribution, then it is not going to be currently taxed. However, what it does is it reduces the basis of your stock so that when you sell the stock, your gain on the sale of that stock is going to be proportionally greater. So, for example, Terrence bought 100 shares of BCD Corp for $1,000, making his basis $10 per share. BCD Corp made a non-dividend distribution to Terrence of $100 cash. So now Terrence's basis in the stock is $900, which is $9 per share. Inherited or gifted property. So the basis of inherited property is the fair market value of that property at death, or if elected by the estate, 6 months after the date of death. So normally, the basis of inherited property is the fair market value at the date of death, but the executor of the estate can make this election that says instead of using the date of death, we're going to use a date that is 6 months after the date of death. So you'll want to know that, but when we talk about it now, we're going to be assuming that it is the fair market value at the date of death. So this is called a step up in basis, and it is a good thing for the person who is inheriting the property. So let's say you have a parent and they bought some Walmart stock back in 1986. And I'm not sure how much they paid for it, but it wasn't very much compared to what Walmart stock is worth today. But they've got this stock that they bought back in 1986. And now they die in 2024 and they leave that stock to their child. Let's say they have one child, they leave this stock to that child. That child's basis in the stock is the fair market value of the stock at the date of death. So even though the parents paid a relatively low price for it, their basis, if the parents had sold it while they were still alive, then they would have had a huge capital gain. But if the child now sells the stock, let's say as soon as they get it from the inheritance, they turn around and sell it, they're going to essentially have no capital gain on that sale because they're selling it for the fair market value at the date of death. So it is a very good deal from a tax standpoint. Contrast that to gifted property. The basis of gifted property, so this is property that somebody gives while they're still alive, they give it to someone. That basis for the donee, the one receiving the property, they get the same basis as the donor. This is called the carryover basis because the same basis carries over from one person to the next. So if we think about our Walmart stock example, if the parent who owned that stock, if instead of waiting until they died in order to bequeath it to their child, if instead they had given that same stock to their child the day before the parent died, now that child, if they turn around and sell that stock, they're going to have a huge capital gain because their basis is the same as their parents' basis, which is very small relative to the value of that stock today. So this is something to keep in mind for parents and grandparents who want to give property to their children or grandchildren or anyone else, is they want to keep this idea in mind. They may be better off just putting that in their will and letting the person inherit it after they die rather than giving it to the person while they are still alive. Now, there is this one exception for a gift, and that is if that asset is sold at a loss, then the basis is the lesser of the donor's basis or the fair market value. So if the fair market value is actually lower than the basis, then you don't get carryover basis. You have to use the fair market value. So maybe this is an old car that someone is going to give to someone else. Let's say a parent bought the car for $20,000 and now it's worth $5,000 and they are giving it to their child. And then the child turns around and sells the car. Well, the child's basis in that car is not $20,000. It is only $5,000. So that's what that rule is for. So what do we mean when we say fair market value? So this is the definition for tax purposes of fair market value, or FMV. Fair market value is the price at which property would change hands between a willing buyer and a willing seller, neither having to buy or sell, and both having reasonable knowledge of all the relevant facts. So you've got someone who is willing to buy an asset, but they're not under any particular pressure that they have to buy it right now, but they're willing to buy it. And similarly, you've got a seller who's willing to sell the asset, but they don't have to sell it. They don't have to have the money right now or anything like that. There's no big pressure on them to sell, but they would be willing to sell it. And both of them have reasonable knowledge of all the relevant facts. So it's not like it's a car and the seller knows that it's got some big mechanical problem that the buyer doesn't know about. No, they both know all of the relevant facts about that car. So what is the price that that car would sell between those two parties? That is that asset's fair market value. So that's kind of an ideal case. That may not happen all the time in the real world, but when we talk about fair market value, or FMV, that's what we mean. So now let's talk about capital gains and losses. That is the title of this video. It's capital gains. So let's talk about what we mean. There are two categories of capital assets. There can be capital assets that are held for investment, and there can be capital assets that are held for personal use. So let's talk about that. Capital assets that are held for investment would be things like stocks, bonds, etc., those investment type of assets, unless they are held by a securities dealer. And we'll talk about securities dealers later. But again, those are people who are in the business of acquiring investments in order to resell those to investors. Other capital assets held for investment: gold, silver, stamps, coins, gems, etc. Again, unless they are held by a dealer in those types of items. Gains on the sale of investment property are taxed as capital gains, and losses are deducted as capital losses. So if it is investment property, then we've got capital gains and losses when those assets are sold or otherwise disposed of. Capital assets that are held for personal use. This is when the property is held for personal use only rather than as an investment. So this would be the family home, the car, the furniture, the clothing, etc. Those are capital assets that are held for personal use. The gains on the sale of those personal use property are generally taxed as capital gains, just like if it were an investment. However, the difference is on the losses. So the loss on an asset that is held for personal use is not deductible. This is why when you sell that old car that you bought for $20,000 and you sell it for $5,000, you don't get to take a tax loss for the sale of that car, because losses on sales of personal assets are not deductible. Holding period of capital assets. So I've referred to this a little bit earlier, but it is a very important concept. Long-term versus short-term capital assets. A long-term asset is one that is held for more than 1 year. Inherited property is automatically considered long-term. So even if the person who died had just acquired that asset, let's say they acquired it a month before they died, now they die and it is inherited by their heirs. Those heirs get to treat that as a long-term asset. The gain or loss on the sale of a long-term capital asset is capital gain or loss, and so it is taxed at favorable capital gains tax rates. Short-term capital assets are held for 1 year or less, and the gain or loss on those is a short-term capital gain or loss, and those are taxed at ordinary tax rates. So when we talk about a capital gain being a good thing, primarily we're talking about long-term capital gains, because short-term capital gains are going to be taxed just like any other type of income at ordinary tax rates, whereas long-term capital gains will be taxed at those favorable capital gains tax rates. You do want to be prepared on the exam for a question. They might say that a certain person purchased an asset on July 1st of 2023, and then they sold that asset on July 1st of 2024. And then they will ask you, is that a long-term gain or is that a short-term gain? And you need to know the answer. The answer here is it is a short-term gain, because that is exactly 1 year, July 1st to July 1st. That would be a short-term capital asset. It has to be more than 1 year in order to be long-term. So you want to make sure you remember that distinction. Capital losses. You can deduct capital losses up to the amount of your capital gains plus an additional $3,000 per year. So remember, we said before that capital losses are limited. So this is what we mean. So if, for instance, during the year, you sell lots of different things, let's say it's stocks and bonds and mutual funds. And so you sell a bunch of those things and you have total gains for the year of $10,000. And you have losses from the year of $6,000. You can deduct all of those $6,000 of losses against those $10,000 of gains. So if you had that example, $10,000 of gains from buying and selling capital assets, $6,000 of losses from buying and selling capital assets, you would have a net gain of $4,000. So you could deduct all of those capital losses. But let's say instead you had $10,000 of gains from buying and selling, and you had $15,000 of losses from buying and selling. You could only deduct $3,000 of your total $5,000 loss. It is limited to $3,000. And as you can see there, if you're married filing separately, then it is limited to only $1,500. But for everybody else, whether you're single, head of household, qualifying surviving spouse, married filing jointly, it is $3,000. So usually in the tax law, married filing jointly gets twice the benefit of somebody who is single. But it doesn't work that way with this. It's $3,000 whether you're single or married filing jointly. The only one who has anything different is married filing separately, which is only $1,500. And of course, both spouses, if they're married filing separately, they each get $1,500. So really between them, they get $3,000. But for either individual, they only get $1,500. If you have excess losses, those can be carried over to be used in future years to offset gains and as a deduction up to that $3,000. So in our example, if you had the $5,000 net loss this year, you can only take $3,000 this year, but now you've got $2,000 that you can carry forward to next year, and you can take that next year. So calculating the net capital gain or loss, in order to figure out your net gain or loss for the year, you go through these steps. In steps 1 and 2, you can do in either order. You don't have to do 1 first and 2 second. It could be vice versa. But in any case, this is how we'll look at it. First thing you do is you total all of your short-term gains and you subtract all of your short-term losses. And this leaves you with a net short-term capital gain or loss. Then you're going to total all your long-term gains and subtract all your long-term losses, which leaves you with a net long-term capital gain or loss. So then step 3 is if those positions are the opposite, so one is a gain and the other is a loss, then you're going to net the two together to get either a net gain or a net loss. If the positions are the same, so they're both gains or both losses, then no further netting is necessary, and you've got two different kinds of income or loss. And we're going to lay this all out on a chart on the next slide so you can see what it looks like. So this leaves you with 4 possible outcomes. So you could end up with a net short-term gain. If you have that, those are taxed at ordinary income tax rates because it is short-term. You could have a net short-term loss. If you have that, then those losses are deductible up to $3,000, and any remainder is carried forward. Or you could have a net long-term gain, in which case those are taxed at capital gains tax rates. Or you could have a net long-term loss, in which case those are deductible up to that same $3,000 limit, and any remainder is carried forward. So these are the 4 possible outcomes, and we will do some examples as well in order for you to see exactly how this looks. So let's talk a minute about those capital loss carry forwards. Any amount that is above the $3,000 can be carried forward indefinitely. However, if the taxpayer dies, any unused losses are lost forever. So if you have, let's say, a $40,000 capital loss for the year, you are going to be limited to taking $3,000 this year. But you're going to have $37,000 that you can carry over to future years. And you can do that indefinitely for as long as you're still alive. So let's say you don't have any more gains or losses in the future years. Well, you can take $3,000 this year. You can take $3,000 next year, $3,000 a year after that, $3,000 a year after that, etc., until the entire $40,000 loss is used up. But then, as it says, if you die in the meantime, any remaining loss is going to just be lost forever, and no one is going to get to take that. If losses are carried forward from a previous year, then as part of the netting process, short-term carryover losses are netted against current year short-term gains, and long-term carryover losses are netted against current year long-term gains. So let's look at some examples. Example 1, Jerry had the following capital gains and losses in 2024. So long-term, he sold some stock for a $2,000 gain. He sold a mutual fund for a $3,000 loss. And then he sold this other stock for a $5,000 loss. Short term, he sold some stock for a $2,000 gain, sold a different stock for a $1,000 loss. So if we look at this, remember we have to net these together. So let's do the long term first in this example. He has a net $6,000 long-term loss. So he had a $2,000 gain, then he had a $3,000 loss. So that's a net of $1,000 loss. And then he had another $5,000 loss. So that's $6,000 net long-term loss. He had a net short-term gain of $1,000. So he had a gain on one stock of $2,000. He had a loss on another stock of $1,000. So that is a net $1,000 gain short-term. So now we're going to net those two together because they're opposite. He has a net long-term loss of $5,000. So he's single. He can use $3,000 of that loss this year to offset ordinary income. The remaining $2,000 loss is carried forward to future years. Example 2. Julie had the following capital gains and losses in 2024. Long term, she sold a stock for a $3,000 gain, a different stock for a $2,000 gain, and another stock for a $1,000 loss. Short term, she sold a stock for a $3,000 gain and a different one for a $2,000 loss. Now, the difference here is she also has a $2,000 long-term capital loss carry forward from the prior year. So her net long-term gain is $2,000. So this year, she had a $3,000 gain and a $2,000 gain. That's $5,000. And then she had a $1,000 loss. So that's $4,000. So she has this year $4,000 gain. However, she's got that $2,000 carryover from the prior year. So we subtract that. So her current year net long-term gain is $2,000. Her net short-term gain is $1,000 because she had those two transactions that net to a $1,000 gain. So in this case, we do not net those two together because they're going the same direction. The long term is a gain and the short term is a gain. So we've got two different kinds of gains. So Julie is single. She will pay capital gains on the $2,000 long-term gain and ordinary tax on the $1,000 short-term gain. And she has no carry forward loss remaining because it's all been used up. So how do we report these sales and these gains and losses? Well, we start on this form 8949, and we're going to start with short-term transactions. And we're going to check a box here, either A, B, or C, and you can read what those are. A is these are transactions that were reported to you on a 1099-B. So that would typically come from a brokerage house. And we check A if the 1099-B shows the basis of the assets, and it reports those to the IRS. And it will say right on the 1099-B, here's your basis, and this is being reported to the IRS. So you would check that box. These days, usually if you're dealing with sales of investments, you'll get a 1099-B, and it usually will show the basis. So you'll be checking box A. However, you could have a 1099-B, but they don't have any basis information to report. So they don't report the basis information to the IRS. So then you would check B. And then C is if you've got a short-term transaction and you didn't get a 1099-B. So you could be selling an asset that wasn't held at a brokerage house. And so you're not going to get a 1099-B. And so in that case, you would check C. And everything you list down here, because down here you're going to list all of these things about the asset, a description of the property, when you acquired it, when you sold it, how much you sold it for, what your basis was. There's these codes and adjustments that can go on there that'll be usually on that 1099-B. And then you're going to show your net short-term gain or loss for that particular asset. And so whatever box you check here is going to apply to everything you list down here. So the point is, let's say you've got some items that you get a 1099-B and the basis was reported. So you'll list all of those here. If you then have some other items, let's say then you've got some short-term transactions that didn't show up on a 1099-B, you're not going to list those on the same list. You're going to attach another 8949 to list those. So when you check a box here, you're only going to check one box per 89.49. If you need to check two boxes, then you attach another 89.49 for the second box. Then we're going to go to page 2, which is the exact same thing, except it's for long-term transactions. So they call it box D, E, and F, but it's the same thing. They correspond to boxes A, B, and C on the previous page. And then you're going to show all of that same information here, just like you did on the previous page. And again, if you have to check more than one box, then you attach another 89.49. Once you've done the 89.49, you are going to transfer that information up here to Schedule D, capital gains and losses. It is possible sometimes to skip the 89.49 and just to put things on Schedule D. We're not going to go over that here. It's not something that's going to be tested on the exam. But when you're doing returns, you'll want to know that, which is why you want to get the forms and the instructions and read through those to understand all of that. But much of the time, we're going to take the information from the 89.49 and it is going to flow up to the Schedule D. And so you're going to see here in Part 1, you're going to list your short-term capital gains and losses. And then in Part 2, you've got your long-term capital gains and losses. And then you've got Part 3 here, which is just a summary and is going to add it all together. And then those amounts are going to flow up to the Form 1040. So now let's talk about those capital gains tax rates. I keep kind of teasing you with, hey, you get this special capital gains treatment and it's lower tax rates than ordinary rates. So what do we mean? So here is the chart that shows you those special capital gains tax rates. So we're going to start over here. We're going to separate taxpayers by filing status. So it depends on what your filing status is and your amount of taxable income. So for example, if you've got a single taxpayer and they make $47,025 or less and they have a capital gain, they are going to pay 0% capital gains tax rate. If that were ordinary income instead of capital gain, their tax rate would be 10 to 12%, depending on where they fall within these ranges of taxable income. So you can see that's a great deal. You have 0% instead of paying 10 to 12% tax. Let's look at the other ones. They all work the same way. So let's say you have married filing jointly, and they've got between this $94,051 and $583,750. Their capital gains tax rate is 15%, whereas if they had ordinary tax rates, they would be anywhere from 22 to 35%, depending again on where they fall within these ranges. And then you can see the one for the highest end taxpayers, the highest amount of taxable income, their capital gains rate is only 20% compared to 35 to 37% for ordinary tax rates. So you will want to know these tax rates, the 0, the 15, and the 20%. The ordinary rates, by the way, we're going to go over in video 5. So we'll show you how the ordinary tax brackets work. But for this video, you will want to remember these rates, the 0, the 15, and the 20%. You don't have to remember these exact dollar amounts of where the cutoffs are. Just be generally familiar with those. And notice how much money they can actually save. They can save anywhere from 10% all the way to 20%, depending on where they fall here. So it is a big savings in tax. So this is why taxpayers like to have long-term capital gains, is because it is taxed 10 to 20% less than ordinary income tax rates. Then also, I'm sure you've noticed these exceptions down here on this chart, and we will talk about each of these things as we go through the rest of this video. So these are exceptions to these general rules that are listed on the chart. Security sales. So as we said in part 1 of the exam, many of the capital gains transactions that we're going to talk about are going to involve securities, stocks, bonds, mutual funds, etc. Those will usually be reported on a 1099-B from a brokerage house, and they will oftentimes provide both the sales price and the basis, the dates they were bought and sold, whether they're long-term or short-term. So the 1099B usually will give you all of the information you need to fill out the 8949 and the Schedule D. It is important to know that mutual funds can generate capital gains in two different ways. First of all, the mutual fund itself will have gains from buying and selling securities. So remember, a mutual fund is when a lot of people put their money all together. I put some money in, you put some money in, lots of other people put some money in. And then the manager of the mutual fund goes out, they pool all of our money together, and then they go out and buy securities, such as stocks or bonds or things like that. So when they are buying during the year, they are likely buying and selling securities. So they can obviously have capital gains as part of that process. And so when they do, they will then make capital gains distributions out to those people who own part of the mutual fund. So that is one way that you can have capital gains from a mutual fund, is you get capital gains distributions from the activity within the mutual fund itself. And then the second way is that you can actually sell your part of the mutual fund. So you buy into a mutual fund, and at some point you may say, you know what, I don't want to own this mutual fund anymore. And so then you can sell it. And so that transaction can also result in a capital gain or a capital loss. So those are the two ways that you can have a gain or loss from a mutual fund. So let's talk a little bit more about those capital gains distributions. When you get those, they will be reported to you on a 1099 div from the mutual fund, and you are always going to report those as long-term capital gains. It doesn't matter how long you held that stock or mutual fund. It doesn't matter how long the mutual fund itself held the particular assets. So the mutual fund, you've got this 1 year holding period. Well, it could be that the mutual fund actually held the stock for less than a year before they sold it, but it doesn't matter if it comes from a mutual fund as a distribution on this 1099 div, then you are going to consider that to be a long-term capital gain. And even if you didn't hold the mutual fund for more than a year yourself, doesn't matter, still going to be considered a long-term gain. Now, if you sell the mutual fund within a year, that gain could be short-term. So remember, there's two ways to have a capital gain. Well, if the way you had the capital gain from that mutual fund is you bought the shares of the mutual fund in January and you sold the shares of the mutual fund in July, well, that's obviously less than a year. So that gain or loss would be a short-term gain or loss. Liquidating distributions. When a corporation is partially or completely liquidating, so they're going out of business, they've decided, you know what, we don't want to be in this business anymore. We're just going to sell all of our assets, pay off our debts, and whatever's left over, we're going to distribute out to our owners, to our shareholders. Well, the first part of that liquidating distribution is going to be a return of capital, which is not taxable. So they're going to basically be giving you your money back. You can think about it that way. Any excess amount over the amount of your basis is a capital gain. So, for example, let's say you bought some stock for $1,000. The company's going out of business, they're liquidating, and so they make a liquidating distribution of $1,500. The first $1,000 of that is not taxable. It is just a return of your $1,000 that you invested. The excess over that amount is a capital gain because it's like you sold the stock at a gain. So you are getting a $500 capital gain. However, what if you receive less than you invested? Well, in that case, you have a capital loss. So if you invested $1,000, company goes out of business, they send you a check for $700. Well, in that case, you invested $1,000, you only got $700 back. So that is then a $300 capital loss. Worthless securities. So if you have a stock that you bought, and let's say the company goes out of business and there is no money to distribute out to you. So they don't distribute anything to you. and the stock is now completely worthless because the company no longer exists. That is a capital loss. So you're going to treat that as if you sold the stock on the last day of the year. So if you're trying to determine, is it long term or short term, you use the last day of the year as the day that it was quote unquote sold, even though actually it's just worthless. And you will report this on that form 8949. And you do have to be able to support the worthlessness. You can't just decide that, this is worthless. You have to actually be able to prove that it is worthless. Wash sales. A wash sale occurs when you sell a stock or other security at a loss, and within 30 days before or after that sale, you either buy substantially identical stock or securities or acquire substantially identical stock in a fully taxable trade, enter into a contract to acquire substantially identical stock, or acquire substantially identical stock in your retirement account, your IRA or your Roth IRA. So, what are we talking about here? At some point in time, some investors thought of a clever trick to get some tax losses. So, here's what they would do. Let's say they bought a stock for $10,000. They had $10,000 worth of stock, and it got to be December, and the value of that stock had gone down. Let's just say it had gone down to $6,000. These investors looked and said, hey, look, I've got a $4,000 loss. If I were to sell that stock today, I would have a $4,000 loss. And of course, you can't take a loss on the stock unless you sell it. You can't just look at it and say, well, it's only worth $6,000. And so therefore it is a loss. You have to actually sell the stock. So what these investors said was, here's what I'm going to do. I still believe in this stock. I like the stock. Even though the value of it is down right now, I think it's going to come back and I think it's going to be a winner. So here's what I'll do. I'm going to sell the stock today for $6,000. That will generate a $4,000 loss. And then tomorrow, I'm just going to buy the stock back. It'll probably be about the same price as it is today. So tomorrow I'll go out and I'll spend $6,000. I'll buy the stock back. So that way I still own the same stock that I owned before, but now I get a $4,000 loss for the year. And the IRS says, no, 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 you cannot do that. That is called a wash sale because one transaction simply washes out or negates the other transaction. So you're not allowed to create a tax loss in that way. And you also can't do it the other way around. You can't say, okay, here's what I'll do. I'll buy some more stock today for $6,000, and then I'll sell my other stock tomorrow that I paid $10,000 for. I'll sell it and take a $4,000 loss tomorrow. Doesn't work either. It doesn't matter if the sale is before or after. It is still a wash sale. You also can't say, okay, I've got a regular account here and I've got this retirement account, this IRA over here. I will sell in my regular account, take the loss, and then I'll buy the other stock. Instead of buying it in my regular account, I'll buy it over here in my IRA. Can't do that either. Any of those things is a wash sale, and losses on wash sales are not deductible. If you have a gain, you would still pay tax on the gain. But if it is a loss, it is not deductible, but you do still report it on the 8949. You just list it as a wash sale. And if you have this and you've done all this through a brokerage house, then it will usually be listed on the 1099-B as a wash sale. Options. So the gain or loss from the sale or trade of an option to buy or sell property that is a capital asset is a capital gain or loss. So usually we're talking about stock options, but it doesn't have to be. You can have an option to buy, for instance, land as well, or other assets. But for ease of discussion, we'll think about stock options. So options, particularly stock options, can be bought or sold. So you don't even own the stock. You've just got an option, for instance, to buy the stock in the future. That option itself can be bought or sold. So if you buy or sell that option, then as long as the asset for which the option is for would be a capital asset if you bought it, then the option itself is also considered a capital asset, and any gain or loss would be a capital gain or loss. If you have a loss from an option because you did not exercise it, then that is considered a sale and a capital loss. So let's say, for example, you buy an option to buy a stock. Let's say the stock today is selling for $20. You think the price of the stock is going to go up. So you buy an option to buy that stock 3 months from now for $21. And you are hoping that 3 months from now, the stock is going to be worth more than $21. So let's say 3 months from now, the stock is worth $25. Well, you've got this option to buy it for $21. So you're guaranteed to be able to make $4 per share on that stock because you can buy it for $21, turn around and sell it for $25. But let's say things don't go as planned. And instead, 3 months from now, that stock, the underlying stock, is worth only $19. So the option has expired. The 3 months has gone by. The option has expired. You have an option to buy a stock for $21 that you could go out into the open market and pay only $19 for. So obviously your option is worthless. Nobody is going to give you anything because they can buy the stock cheaper without the option. So now you have lost your money that you spent on that option. That loss is a capital loss. If the option is part of a straddle, so this is an investment strategy, you buy one option to buy, one option to sell the same security, it limits your risk. You don't report either side of that, the buy option or the sell option. You don't report the gain or loss until both positions have settled. So maybe one option is for 3 months and the other option is for 4 months. You're not going to report either of those until the 4 months has gone by and both sides have settled. Incentive stock options. We actually talked about these in the previous videos. You saw this same slide then, so I'm not going to spend a lot of time on it. But just as a reminder, if you have statutory incentive stock options, you don't have any income until you sell or exchange the actual stock, and it is taxed at capital gains rates. If they are non-statutory, then you do have income when that stock option is received, as long as you can determine the fair market value of that option. And if you can't determine the fair market value, then it is taxable when that option is exercised or sold. And again, you get to use capital gains rates. Employee Stock Purchase Plan, or ESPP. This is a corporate benefit that allows employees to purchase the company's stock at a discount. So as long as it is a qualified plan, there is no income until the stock is actually sold. If it is sold more than 24 months after the offering date and more than 12 months after the actual purchase date, then there is favorable treatment for that. The gain will be a mix of ordinary and capital, and it's going to depend. It's not a set thing all the time. So the company will let the employee know. They'll give them this form 3922, that shows them the amount of the gain that is ordinary and the amount of the gain that is capital. But for the exam, you just need to know that if you have one of these employee stock purchase plans, that it does get this special treatment, and you've got the 24-month and 12-month rule. A publicly traded partnership, a PTP. A PTP is any partnership with ownership units traded on an established securities market or with units that are readily tradable on a secondary market. So a PTP is a partnership that is bought and sold much like a stock. So by default, PTPs are treated as corporations. And so since you're buying and selling it just like you would as a stock, and since it's treated as a corporation, then the gain or loss is very straightforward. It's just like the gain or loss on a sale of a stock. You have your basis, you have your sales price, whatever the difference is, that is your gain or loss. However, it is not actually a corporation. It is actually legally a partnership. So there's this exception. if 90% or more of the PTP's income comes from certain types of passive incomes, then it is treated as a partnership rather than as a corporation. And that means that the owners will get a K1. Any losses that flow through from a K1, from a PTP, are passive losses and therefore are subject to the passive activity loss rules. Remember, you can only offset passive losses against passive gains. So if you have one of these special kind of PTPs that 90% or more of their income is from passive income, then you're going to get this K1. Any losses that flow through are going to be passive losses. Any cash distributions from one of these PTPs that is treated as a partnership can lower your basis. So remember when we said if you had a non-dividend distribution from a stock, that could lower your basis, was the same idea here. You get a distribution from one of these PTPs that's being treated as a partnership, that will lower your basis in that PTP, which means you could have a higher than expected gain once you someday sell that PTP. Because of some very complex partnership rules, some of the gain on the sale can be ordinary rather than capital. So if you have one of these PTPs that is treated as a partnership, it can get very complex. Some of it can be ordinary, some of it can be capital. You don't need to know all the ins and outs. The EA exam will not get that detailed. You just have to have the general idea of how this works. And again, remember, most PTPs, you don't have to worry about all this partnership stuff. Most PTPs are going to be traded just like a stock, and so it's very easy. It's only if the PTP has more than 90% of their income as passive income that you have to worry about any of this other alternative treatment. Small business stock, Section 1244 stock. And you're going to want to remember this Section 1244. We're going to have other section numbers that apply. So you'll want to be able to distinguish between these. So Section 1244 stock. This is stock in a domestic small business corporation that is primarily operating a business rather than investing, and you're the original owner of the stock. So you've got a business, and it's not a business that you're just using to invest in things. You're actually running a business, and you're the original owner of the stock. So you've started this company. That is Section 1244 stock. The loss on the sale or worthlessness of that stock can be treated as an ordinary loss up to $50,000. And it's $100,000 if you are married filing jointly. Any loss in excess of that $50,000 or $100,000 will be treated as a capital loss. Any gain on the sale of Section 1244 stock is a capital gain. So this is a good deal. Remember, we said taxpayers like to have capital gains and ordinary losses. That's exactly what you're getting with Section 1244 stock. If you have a loss, it is an ordinary loss up to those limits, which means there's no $3,000 maximum for the year. You can take the whole loss for the year. And if it's a gain, it is a capital gain. So you get those favorable capital gains tax rates. So it really is the best of both worlds. Small business investment company stock. This is a similar idea. A small business investment company is one that is licensed and operated under the Small Business Investment Act of 1958. So you just want to remember that. You don't have to know all the details of that. Any loss on the sale or worthlessness is an ordinary loss. So again, that's a good thing. No limit on the capital loss. And the gain on the sale is a capital gain. So again, best of both worlds. And on this one, there is no limitation. You don't have that $50,000 or $100,000 limit on the amount of the loss that is considered ordinary. Section 1202 stock, sometimes called qualified small business stock. Usually, though, we call it Section 1202 stock. This is a great deal. So you're going to want to know this for the exam, but probably more importantly is you're going to want to watch out for this for your clients. So this is for C corporations, and we'll go into all different types of corporations in part 2. But this is for a C corporation that operates a qualifying business, and there are strict rules about this. So you have to go through very carefully to make sure your clients qualify for this. But if they do qualify, it is a great deal. So it has to be a qualifying business, and the stock has to have been held for at least 5 years. And remember, it has to be a C corporation. So you have to have all of those things, and there are other rules as well. If you meet all of those rules, you can exclude all or a portion of the gain up to $10 million. That is not a typo. Up to $10 million or 10 times the initial basis in the stock, whichever is greater. That means the gain is tax-free. It's not that it's taxed at favorable capital gains rates. There is no tax at all on up to $10 million of the gain if you have this qualifying Section 1202 stock. Now you can see there are these special rules for these time periods. If the stock was acquired before February 17th of 2009, then you can only exclude 50% of the gain. If it was acquired between these two dates, this short period of time in 2009 and 2010, then it's 75% of the gain. And if it was acquired after September 27th of 2010, you can exclude up to 100% of the gain. So again, you want to know it for the exam, of course, but if you have any clients who have this, they will love you for telling them about this because this is a fantastic deal. Now let's talk about investors, dealers, and traders. Understand what these are and what the differences are. Investors. Investors buy and sell securities and expect income from dividends, interest, or capital appreciation. They typically hold the securities for a substantial period of time, and they are not in the business of investing. So this is most of us. If you invest in anything, even if you got a bank account that earns interest, or if you own any stocks or mutual funds or anything like that, most likely you are just an investor. I am just an investor. We invest in things. We're hoping to get a return on that investment. We've got our regular day job and we're investing any money that we've got saved up. We are investors. Any sales of those securities will result in capital gains and losses, just like we've been talking about in this video. And they are subject to the normal capital loss limitations, just like we have been talking about in this video. Dealers. Dealers purchase securities and resell them to their customers. We've talked about this a little bit before. And they may keep an inventory of those securities. So they derive their income from marketing securities to customers or by being compensated for services provided as an intermediary or a market maker. They must use something called the mark to market rules. So dealers, again, they're like merchants. They're buying products in order to resell them to customers. It just so happens that the products they're buying are investments. And so if they are a dealer, then they have to use these special mark to market rules. Traders. Think about day traders. They are in the business of buying and selling securities for their own account. And it is considered a business even though they don't have any customers and they don't have any inventory or anything like that. In order to be considered a trader, they have to meet all of the following conditions. They must seek profit from daily market movements. Their activity must be substantial, and they must carry on the activity with continuity and regularity. In other words, they are treating this as a business. This is what they do for a living. They are doing it essentially full time, or it is their main activity that they are doing to make a living. That is what it takes in order to be a trader. If a person is a trader, they are in a business, they can report their expenses as well as their income on Schedule C, but they do not have to pay the self-employment tax. So usually, if you've got a business, you have to pay self-employment tax because it's considered earned income, like we said before. But what they're saying with traders is they don't have to pay self-employment tax. And traders can elect whether or not they want to use those special mark-to-market rules that we are going to talk about. So dealers have to use those mark-to-market rules. Traders can elect whether or not they want to use those mark-to-market rules. So what are these mark-to-market rules? Mark-to-market says this: any securities that you hold at the end of the year must be treated as if they were sold at its fair market value on the last business day of the year, and you must recognize any gain or loss that results. So remember, we said when we were talking about the wash sales that the only way you can have a loss is by actually selling the stock. So just because you bought the stock for $10,000 and now it's worth $6,000, you don't get to take a $4,000 loss from that. You actually have to sell the stock. Well, mark to market is an exception to that. What mark to market says is that you are going to recognize a gain or loss, even though you haven't sold that stock. So you have to look at all of your securities that you hold on the last business day of the year, and you have to say, if I were to sell it today, would I have a gain or loss? And then you have to compute that, and then you have to pay tax on any gain. And then if you have a loss, then you have a loss. So that's what mark to market means. Traders can elect, as we said, to do mark to market. Investors cannot elect to do it. So you and I, as investors, we cannot make this election. We only get a gain or loss if we actually sell the security. We cannot choose to treat it as if we sold it. Traders can make that choice if they make a valid election to do so. Dealers have to use it. They don't have a choice. They're in the business of marketing these securities, so they have to mark to market any securities that they own at the end of the year, and then they will compute any gain or loss at that time. For traders, if they do make this mark to market election, all gains and losses will be treated as ordinary gains or losses. So if they make the mark to market election, they do not get the favorable capital gains treatment. However, they are also not subject to the capital loss limitation. So that $3,000 a year, if they make the mark to market election, they don't have that limitation. So if they have a loss, they can deduct the entire loss. Also, if they make the mark to market election, the wash sale rules do not apply to them. So they don't have to worry about buying and selling the same security within 30 days. Those rules do not apply to them. A trader has to make this election by the due date of the prior year's tax returns, and it does involve something called an accounting change. This means they have to make the election early in the year. They have to make it by April 15th. So the prior year's tax return is due in April 15th. So if you're a trader and you want to make a mark-to-market election for 2024, you have to do so by the due date of the 2023 tax return, which was April 15th of 2024. So you have to make the election with the IRS. You actually have to send in a form to make the election by April 15th. Similarly, if you want to revoke an election, so once you make this election for 1 year, you are going to use mark to market from then on, unless and until you revoke that election. And if you want to revoke the election, you also have to do it by April 15th of that year for which you are revoking it. You do not get to wait until December to decide whether or not you want to use this mark to market, because that would be great. If you could wait until December, you could just wait and see, how does your year go? If you end up that you have a lot of gains, you could say, you know what, I'm not going to make a market to market election because I want the capital gains tax treatment. So I won't make the election. So my capital gains will all be taxed at favorable capital gains tax rates. But if you get to December and you have a loss, hasn't been a good year, you got a lot of losses, you say, you know what, I'm going to go ahead and make the mark to market election. So that way I don't have this $3,000 limitation on my losses, and I can deduct all of my losses. You're not allowed to do that. The IRS says you have to decide by April 15th each year whether or not you want to make that mark to market election for that year. And again, once you make the election, it is going to be in effect until you revoke it. Section 1256 contracts. So anyone, doesn't matter if you're an investor, a dealer, a trader, if you own any of these special kinds of contracts called Section 1256 contracts, then you have to mark to market at the end of the year. And these are those contracts. It's a regulated futures contract, a foreign currency contract, a non-equity option, a dealer equity option, or dealer securities futures contract. Any of those, and again, you don't have to understand what those are for the EA exam. You just need to be familiar with the list. Any of those are a Section 1256 contract. And if you have those, you have to mark to market. And so you hold it at the end of the year. You treat it as if it was sold on the last business day at its fair market value. And then you recognize any gain or loss that results. This does not apply to a hedging transaction. So if you have certain hedging transactions where the only reason you're entering into this contract is to hedge a position in another security, you can identify that and mark that in advance, and then this treatment will not apply to that. But if you hold any of these contracts, you make the mark to market adjustment at the end of the year, you recognize any gain or loss. There's a special rule about how it is handled. 60% of your gain or loss will be considered long-term and 40% will be considered short-term. So it doesn't matter how long you actually held the contract, you are going to have this special 60-40 rule that applies. So for the exam, just remember Section 1256 contract, you have to mark to market, and it's got this special 60-40 rule. Digital assets or cryptocurrency. For federal tax purposes, digital assets are treated as property, just like any other type of property. So the general tax principles that are applicable to any other type of property apply to the digital assets as well. So these assets are not considered currency. They are considered property. And remember, you've got that checkbox on page 1 of the 1040 that you have to say yes or no about whether or not you had any of those transactions in those digital assets. You can have a taxable gain or loss as a result from lots of different types of transactions, including, but not limited to, all of those you see on your screen. So from the sale of the digital asset, from an exchange of a digital asset for property, goods, or services. This happens a lot these days. There are service providers who are accepting digital assets instead of cash for their services. So you can have an exchange. You can have tax on that exchange. You can have tax on the exchange or trade of one digital asset for another, on the receipt of a digital asset as payment for goods or services, on the receipt of a new digital asset as a result of a hard fork or as a result of mining or staking. I barely understand what those things mean, but if you're into cryptocurrency, then you will understand what that means. Receipt of a digital asset as a result of an airdrop, any other disposition of a financial interest in a digital asset, and you have to pay tax on the receipt or transfer of a digital asset for free if that does not qualify as a bona fide gift. So if you have an actual real gift, then you wouldn't have to pay tax. But if you are receiving this digital asset for free and is not a bona fide gift, then you would, in fact, have to pay tax on that. The gains and losses are treated the same as other gains or losses. So if the fair market value of the crypto received exceeds basis, you have a gain. If the basis exceeds the fair market value, then you have a loss. If it is a long-term capital gain, it's taxed at the capital gains tax rates. And if it is a loss, then it is limited to the same $3,000. If it is ordinary income, such as crypto received by a self-employed person for performing services, then you are going to treat that as gross receipts in your business at the fair market value in US dollars at the time it was received. So you don't look and see whether or not the value went up or down by the end of the year. It is the value at the time it was received that counts as income. If you use it to pay business expenses, then similarly, it is the fair market value in US dollars of that crypto at the time it was paid. This could also result in a gain if your basis is lower than the fair market value. So let's say you received the crypto for services that you performed, and at the time you received it, it was worth $100. And now, several months later, you are paying some other service provider for something they did. And let's say you are paying for services that are worth $500. So they accept that crypto as being equivalent to $500. Well, your basis is only $100 because you received it for services you performed for $100. That becomes your basis. So if now you use it to purchase goods or services worth $500, you have a $400 gain on that crypto. Crypto is reported on a 1099 miscellaneous. So if you've got $600 or more that has been paid to an individual or a partnership using crypto, then if you are a business, you have to issue a 1099 miscellaneous for that. Or you could be the one receiving the 1099 miscellaneous if you were paid $600 or more worth of crypto. For more information on this, you can see this IRS notice. It's IRS notice 2014-21. It goes into more detail about all of that. Collectibles. Collectibles are things like art, rugs, antiques, metals, gems, stamps, coins, alcoholic beverages like wine, musical instruments, historical objects, and similar assets. This includes precious metals-based ETFs, which are exchange-traded funds. It also includes an equity interest in a pass-through entity that holds collectibles, such as a partnership or an S corporation. And the IRS can deem assets to be collectibles. So it's not just that there is one set list of things that are collectibles. Obviously, over time, different things can pop up that suddenly become collectibles. So there's not one static list of things. There are general types of assets that we've talked about here that are considered collectibles, but the IRS can deem other assets to be collectibles as well. When you sell a collectible, it is taxed technically at ordinary tax rates, but the maximum rate is 28%. So even if you're in the 35 or 37% tax bracket, the gain on the sale of the collectibles will only be taxed at a maximum of 28%. This is one of those asterisk items that was at the bottom of that capital gains chart, was for collectibles. Losses on the sale of collectibles are not deductible unless they were held for an investment. So in other words, just because you own a collectible doesn't mean you bought it as an investment. You could have bought it just because it's something that you liked. You weren't actually buying it with the intention of selling it someday to make a profit. So if you don't hold it for investment and you sell it at a loss, then you cannot take any loss on that sale. So it's going to depend on your intent of purchasing it. So think about like baseball cards. If you just bought baseball cards because you like baseball, you like baseball cards, then that would be a personal asset. If you sell it at a loss, then it is not deductible. But if you're wanting to actually make money from that, the reason you bought the card is because you thought, hey, I'm going to buy it for this price today, and I think I can make a profit on it. So I'm going to hold it and sell it later. And you end up selling that for a loss, then you actually can deduct that loss. And the IRS is going to look at the facts and circumstances on a case-by-case basis. So again, you can't just decide that this is what it was. Oh, yeah, I really did buy that as an investment. It's going to depend on the particular circumstances in each case. Bad debts. If you got a business bad debt, that could very well be deductible. We'll talk about that in part 2. But for part 1, we want to talk about non-business bad debts. These may be deductible as a short-term capital loss, but they have to meet certain criteria. First of all, it has to be a genuine debt. It was not intended to be a gift. And a loan from a parent to a minor child to pay for their basic needs is not a genuine debt. So you cannot just say, okay, I'm going to loan my child money to pay for food and shelter, et cetera, and so forth. And then, oh, look, they didn't pay me back. So therefore, I have a loss on that debt. No, that is not a genuine debt. Also, you must have basis in the debt, which means you actually loaned out some money. It is not a bad debt just because you didn't receive something that you should have. So let's say you were owed child support, the person never paid you the child support. That is not a bad debt because you never paid out any money. This has to be a loan that you made to someone that they did not pay you back. If you do have this, it's a genuine debt, you've got basis in the debt, and it is worthless, then you can deduct it in the year that it becomes worthless, which means you no longer have any chance that it will be repaid. And again, you have to be able to prove that that is the fact, that you no longer have any chance that that debt will be repaid. And again, if you do that, it is a short-term capital loss. So it will be subject to all the same limitations as other capital losses, that $3,000 per year. Sales of non-capital assets. So we've been talking about capital assets, but it is possible to sell a non-capital asset. Usually, though, that is going to be in the context of a business transaction. So we will talk about that in part 2. Non-taxable and other sales. So we've been talking about taxable sales, but there are some sales that are not taxable or that are partially taxable and partially not taxable. So let's talk about those. First of all, transactions between spouses. So generally, there is no gain or loss recognized on a transfer of property between spouses, or if it's incident to divorce, former spouses. So husband and wife can sell or transfer items back and forth all day long. Doesn't matter. There is no gain or loss on that. Or if that's done incident to divorce, also no gain or loss on that. Any such transfer is going to be treated as a gift. So the receiving spouse's basis is going to be the same as the gifting spouse, just like any other gift. And that's true even if the property is sold for a loss. So remember before we said if you have a gift that the donee and the donor have the same basis. There's this carryover basis, but there was this exception, and that was that if you sold the item for a loss, then you had to take the lower of the donor's basis or the fair market value. But if you're dealing with spouses, you don't have that issue. It's always a carryover basis when it is done between spouses. Related parties. Losses on sales between related parties cannot be deducted. So this would be family members, corporations, and a greater than 50% owner. They are considered related parties. So any losses on transactions between them cannot be deducted. Transactions between a fiduciary or a beneficiary and a trust cannot be deducted, etc. So any close type relationships, you cannot deduct a loss. The IRS is just trying to prevent shenanigans here. You have people that are just creating tax losses by selling something to a related party at a really low price, getting a tax loss, and then the other person just lets them keep using the asset or whatever. So it's really a manufactured tax loss. So they're just going to say if you're related parties, you just cannot deduct a loss, period. Now, if you have a gain, that is still taxable. They're still going to tax that, but you cannot take any losses. Sale of a primary residence. So your home, as we said before, is a capital asset. And the general rule is if you have a gain on the sale of a capital asset, then it is taxable income, even though it is a personal capital asset. However, there are special rules when we are talking about your primary residence that may allow you to exclude all or part of the gain. So if you qualify, you can exclude up to $250,000 of gain. And if you're married filing jointly, you can exclude up to $500,000 of gain. So we're going to go into what it means to qualify here in a minute. But just know that in general, if you qualify and it is your primary residence that you are selling, you can exclude up to $250,000 or $500,000 married filing jointly. But remember, You cannot deduct any loss on the sale of a personal use asset, even your home. So if you sell your primary residence at a loss, you cannot deduct that loss. And if you have a gain, you may be able to exclude it. So how do you qualify for this exclusion? In order to qualify, you have to meet two tests. Actually, there's kind of three tests, but they call it two tests. So that's what we will call it as well. Test number one, during the 5-year period ending on the date you sold your home, you owned it for 2 years or more. That's called the ownership requirement. And you lived in it as your main home for 2 years or more. That is called the use requirement. The 2 years of ownership and the 2 years of use do not have to be the same 2 years. If you are married filing jointly, in order to double the exclusion from $250,000 to $500,000, only one spouse has to meet the ownership requirement, but both spouses have to meet the use requirement. So that's the first test. Ownership and use for at least 2 years out of the last 5 years. Second test, you haven't excluded gain on the sale of a primary residence of another main home during the 2-year period ending on the date of the sale of your home. In other words, you can only do this once every 2 years. If you just excluded a gain a year ago, you cannot exclude another gain now. You have to wait at least 2 years. So for most people, this is actually pretty straightforward. If you owned your house and lived in it for the last 2 years and you haven't excluded another gain in the last 2 years, then you get this $250,000 exclusion or $500,000 exclusion if you are married. It can get a little bit more complicated in other situations, and so we will look at a couple of examples so we can explain this a little bit better. Example number 1. John is single and started renting a house as his primary residence on August 1st of 2019. So he didn't own it, he was renting. On July 1st of 2021, he bought that house and continued to live in it until October 1st of 2021 when he got married and moved into a new house with his wife. He allowed his brother to live in the first house until John sold it on August 1st of 2024, realizing a $200,000 gain. John can exclude the gain because he met the tests. He owned the house for 3 years and 1 month as of the date of sale, July 1st, 2021 to August 1st of 2024. So he satisfied the ownership test, and he lived in the house as his primary residence for 2 years and 2 months, from August 1st of 2019 to September 30th of 2021. So he met the use test. Notice he did not own the house for the entire time that he was living in the house as his primary residence, but it doesn't matter. All that matters is that you owned the house for at least 2 years out of the last 5, and that you lived in the house as your primary residence for 2 years of the last 5. Those time periods do not have to overlap. So John can exclude the entire $200,000 gain. Notice he can exclude up to $250,000 whether he is married filing jointly or married filing separately. Because if he's married filing jointly, in order to qualify for the larger gain, the $500,000 gain, then his wife would have had to have at least met the use requirement. She would have had to have lived there for 2 years. In this example, she did not. And so he would not have qualified for any gain greater than $250,000. But in our particular example, that didn't matter because the gain was only $200,000. Next example. Maria is single and bought a house on July 1st of 2020 in New York, and she lived in it as her primary residence. On January 1st of 2022, she entered into a 2-year master's program in California where she rented an apartment. While she was out there in California, her brother lived in her New York house. On February 1st of 2024, Maria decided to stay in California to pursue a doctorate, and she sold her New York house, realizing a gain of $200,000. Maria has to pay capital gains tax on the $200,000 because even though she did meet the ownership test by owning the house for 3 years and 7 months, she did not meet the use test because she only lived in it for 18 months, from July 1st of 2020 to December 31st of 2021, instead of the required 24 months. So we will revisit Maria shortly, but in this example, she cannot exclude any of the gain, and she will pay tax on that $200,000, long-term capital gains tax on that. Partial exclusion. So if you do not meet the eligibility test, it is still possible to qualify for a partial exclusion of the gain. In order to qualify, the main reason you sold your home had to be either because you had a change in workplace, it was health related, or it was some other unforeseeable event. So if you had any of those things, you may qualify for a partial exclusion, even though you don't meet the normal eligibility tests. The exclusion amount is the percentage achieved of the failed test multiplied by 250,000 or 500,000 if you're married filing jointly. So if you failed the test because you only lived in the house for 12 months instead of 24 months, then you can exclude half of the $250,000 or $125,000. So let's look again at Maria, but let's change the facts a little bit. So everything here is exactly the same, except for the reason that she moved. In this case, when she moved to California, it wasn't to go to school. It was because she accepted a 2-year out-of-state assignment with her employer. So she went out to California. She rented an apartment, and her brother lived in the house back in New York. But after that 2 years was up, her employer decided to go ahead and give her a permanent position out there in California, and she accepted. And so then everything else is the same. She sold her house. Well, in this case, she does get a partial exclusion. So she met the ownership test because she owned the house for 3 years and 7 months. But as we said, she did not meet the use test because she only lived there for 18 months. But because she moved due to a change in job location, she can exclude 18 divided by 24 times 250,000 or $187,500. So she had a $200,000 gain. She can exclude $187,500 of that gain, and she will pay tax only on the remaining $12,500, and that is a long-term capital gain. Depreciation recapture. If you ever rented out your home, or if you ever took a home office deduction, you may have been entitled to a deduction for depreciation. Remember, depreciation is only for business use, but business use of your home is business use. And if you rented it out, then that counts as well. So when you sell that home, you are usually going to have to recapture depreciation. Recapture means you're going to have to pay tax on it. So even if the gain was otherwise excluded, so you met those requirements for excluding the gain, you're still going to have to be taxed on the amount of depreciation that you took. We call that recapturing the depreciation. And the tax on that is your ordinary rate up to 25%. So this was another asterisk item on that capital gains chart. This is a gain on what we call Section 1250 property, and it is taxed at a maximum of 25%. We'll get into all the 1250 property stuff in part 2, so don't worry about that now. For now, just know that depreciation recapture is taxable at a maximum rate of 25%. And the purpose for this is to prevent a double benefit of both excluding the gain on the sale of your main residence and getting to take that depreciation deduction. And so they make you pay tax on the depreciation. So let's do an example. Lawrence is single and he's in the 35% tax bracket. He bought a home and he rented it out for 2 years. And while he rented it out, he took $22,000 in depreciation deductions, but then he moved into that as his primary residence. After living in the house for 3 years, he sold it for a gain of $200,000, which of course he meets the exclusion requirements. So he was able to exclude that whole $200,000. But since he previously took $22,000 of depreciation deductions, he now has to pay 25% tax on that $22,000. Reporting the sale of a primary residence. You need to report the sale on your tax return on a Form 8949 if either you cannot exclude all or part of the gain, or you received a Form 1099-S. A 1099-S is going to come from the title company or whoever did the closing on the sale of the property. So we'll just say the title company. So if the title company has reason to believe that this is not your primary residence, then they will issue you a 1099-S that will say, here are the proceeds you got from selling that residence. If they have reason to believe that it is your primary residence, they are likely to not issue you a 1099-S. So you have to report the sale if they do issue you a 1099-S, or if you cannot exclude all of the gain. So whether or not they issued you a 1099-S, if you cannot exclude all or part of the gain, you have to report the sale on your 8949. But note, if you can exclude all of the gain and you did not receive a 1099-S, then you do not have to report the sale on your tax return. I find this to be fascinating. Everybody always thinks of the IRS that they're out to get you and they want to know everything about your life and they're trying to get every penny that they can. For most people, selling their home is going to be the largest or one of the largest financial transactions that they have in their entire life. And yet, if you can exclude all of the gain and you don't get a 1099-S, you never report that to the IRS. You don't report it. The title company doesn't report it. Nobody reports this to the IRS. I just think that that's a very interesting fact. If you do have depreciation recapture, then that is going to be reported on line 19 of Schedule D. And of course, you will be reporting the sale to the IRS because part of the sale was in fact taxable, could not be excluded. And if you want any of the details on this, you can check out publication 523. Foreclosure or abandonment. Normally, as we said in the previous video, if a debt is forgiven, the amount forgiven is cancellation of indebtedness income. But there were some exceptions, if you'll remember. And one of those is if it is qualified principal residence indebtedness, then it is not included in your income. If a home is foreclosed on, the lender accepts the proceeds from a short sale, or the owner just hands over the keys to the lender and abandons it, and the lender accepts the property as full satisfaction of the debt, then the amount of debt forgiveness may be eligible for exclusion from income. So if you have a situation, person cannot pay their mortgage anymore, in one way or another, they end up giving the house back to the lender. And the lender says, okay, we're not going to pursue this any further. We're just going to accept, even if we got less than the amount of your loan, we're going to just let it go. We're going to take the house back. And if we had a loss, we're just going to accept any loss. That would normally be cancellation of indebtedness income. However, as long as it is qualified principal residence indebtedness, then it will not be cancellation of indebtedness income. So there are certain criteria that have to be met in order for this exclusion to apply. First of all, the debt had to be to buy, build, or improve the home, or to refinance a debt that was to buy, build, or improve the home. If it was a cash out refinancing and the cash was used for something else, such as paying off a different debt, then the cashed out amount is not eligible. And we're going to look at an example of this to explain it here in a minute. And then the other criteria is this did have to be your main home. If this was a second home or a vacation home, then this does not apply. It's not qualified principal residence indebtedness. When you have this situation, then the lender will issue a 1099-A to the borrower. So let's look at an example. Peter borrowed $200,000 to buy his house. Later, when the balance of the loan was $175,000, he refinanced to pay off the first mortgage, the $175,000. Plus, he got cash out of $25,000 that he used to pay off his car. So now he's got $200,000 loan again, and he has paid off his car loan. His qualified principal residence indebtedness is $175,000. The extra $25,000 that he used to pay off the car does not count as qualified principal residence indebtedness. So, shortly thereafter, after he does this refinancing, the lender foreclosed on the property and accepted the property as full payment of the loan. Peter has $25,000 of taxable debt cancellation income. If the entire mortgage had been principal residence indebtedness income, he would have zero debt cancellation income. But because he used that $25,000 to pay off his car, that piece does not count. And so he does have debt cancellation income for that $25,000. Installment sales. If you sold property at a gain and will receive a payment or more than one payment in a tax year after the year of sale, then you can report that as an installment sale. Part of the gain will be recognized in each year that one or more payments are received rather than all in the year of sale. So it is a sale of property and it is done in installments, right? So that's why it's called an installment sale. So you're going to accept some of the money this year, some of the money next year, maybe some of the money the year after that, and etc. Now, this does not apply to sales of stocks and securities that are traded on an exchange. And you can elect out of this installment sale treatment if you want to and simply recognize all of the gain in the year of sale. And it also does not apply to sales that result in a loss. You report any of these installment sales on this form 6252, and you use that form in each year that any payments are received for that. So if you have this installment sale, part of each payment that you received is going to count as a return of your basis in the property. Part is going to count as interest income, and part is going to count as the gain on the sale of the property. The gain on the sale is determined by multiplying the gross profit percentage by the amount of the payment that is received. The gross profit percentage is determined when the sale takes place, and it is applied to each payment. So, for example, you sell a property with a contract price of $60,000 and your gross profit is $15,000. So, in this case, your basis would have been $45,000. So, your profit is $15,000. Therefore, your gross profit percentage is 25%. It's the $15,000 profit divided by the $60,000 contract price. After subtracting interest, you're going to report 25% of each payment as installment sale income. Don't worry about how you compute the interest. You don't need to know that for the exam. Just know that after you do subtract that interest, 25% of each payment is going to be treated as an installment sale because 25% is your gross profit percentage in this particular example. Like-kind exchanges, also known as a Section 1031 exchange. If you trade business or investment real property solely for other business or investment real property of a like kind, then you do not pay tax on any of the gain or deduct any of the loss from the trade. So it has to be real property that is exchanged for other real property. Used to be you could do this for personal property as well, like if you have machinery and equipment, but now it is only for real property. You report this on a Form 8824 and on Schedule D. In order to qualify as a Section 1031 like-kind exchange, you have to meet all 6 of these conditions. First of all, it has to be business or investment property. So you don't do this with like your personal residence, for example, business or investment property. Secondly, the property that is traded and received has to be real property, as we said. Thirdly, the property must be like kind. Now, the good news is
real estate for real estate will be considered like kind as long as both are in the United States. So you can exchange, for instance, a piece of land, vacant land, for a warehouse, and that would qualify because they are both real property. So it would qualify as a like kind exchange. The property must not be property that is held for resale. So if you are a home builder and you've got a bunch of homes that you've built and that you are then selling to customers, that is property that is held for resale. So you could not then do a like kind exchange of those homes. Next, the property to be received must be identified within 45 days after the date you transfer the property given up. So you don't have to actually know the exact parcel of property that you are going to be receiving in exchange for the property you are giving up on the date that you give up that property. You can identify that property later. It just has to be identified within 45 days after you transfer the property that is given up. Next, the property received must be received by the earlier of the 180th day after the date you transfer the property that's given up, or the due date, including extensions, of your tax return for the year in which the transfer of the property given up occurs. So it's the earlier of those two. So for purposes of the exam, just know that these like kind exchanges exist. There is no tax effect for them. And you want to know these days, the 45 days, you have to identify the property within 45 days, and you have to actually receive the property that you're getting within the earlier of the 180 days or the due date of the tax return. Now, it is possible to have a like kind exchange that is partially taxable and partially not taxable. That happens if you receive, in addition to property, you receive money or not like kind property. So that money and not like kind property we call boot. So if you receive any boot in addition to the like kind property, then you do have to pay tax on the gain up to the amount of the boot. If you pay boot, as long as all the other conditions are met, then it still counts as a non-taxable trade from your standpoint. But if you are the one receiving boot and you have a gain, then you have to pay tax on the gain up to the amount of the boot received. Involuntary conversions, otherwise known as a Section 1033 conversion. An involuntary conversion occurs when your property is destroyed, stolen, condemned, or disposed of under a threat of condemnation, and you receive other property or money in payment, such as insurance or a condemnation award. This is treated as a sale, and the gain or loss is generally going to be recognized in the year that it was realized. In other words, whenever you received the money, you are going to count that as a gain. The amount of the gain is, as you would expect, the amount received less the adjusted basis. However, you do get to subtract any costs of obtaining that award. So let's say you had to hire a lawyer in order to get the money. You can subtract the costs of the lawyer fees from the proceeds when you are determining the gain or loss. Now, it is possible to actually postpone that gain. So instead of paying tax on that gain in the year that you received that money, you can postpone that gain if you receive or purchase a replacement property within the replacement period. So if you lose one piece of property because of an involuntary conversion, but you go out and you buy a replacement piece of property within the replacement period, then you don't have to pay tax. That tax will be postponed. So the replacement period in general is 2 years. So if you acquire a replacement property within 2 years, then you can postpone the gain. There are a few exceptions that you get more than 2 years. If it was for real property used in a trade or business or held for investment, then that replacement period becomes 3 years. If it was for your main home that was in a federal disaster area, then that replacement period is 4 years. And if it is for livestock in an area eligible for federal assistance, it is also 4 years. So remember, for the exam, general rule, involuntary conversion, replacement period is 2 years. And then you have these exceptions: 3 years for real property used in a trade or business, 4 years for a main home in a disaster area, 4 years for livestock in a area eligible for federal assistance. For these involuntary conversions, you need to remember that losses on personal use assets are generally not allowed. However, there is this exception. So if you have a casualty or theft loss in a federally declared disaster area, then you can deduct part of that loss. First, you reduce the loss by $100, and then you can deduct what remains, but only to the extent that it exceeds 10% of your adjusted gross income. So if you have a loss in a federally declared disaster area, let's say you have a $20,000 loss. What you would do is you would subtract $100, so your loss would now be $19,900. And you can deduct that $19,900, but only to the extent it exceeds 10% of your adjusted gross income. So let's say your adjusted gross income is $100,000. 10% of that is $10,000. So you would be able to deduct $9,900 of that amount on your taxes as an itemized deduction. For certain major disasters, those are disasters that are declared under Section 401 of the Stafford Act of 2016. So these basically have to be declared by Congress. But if you have one of these major disasters, then you don't have this 10% of AGI rule. In that case, you reduce the loss by $500 instead of $100. So in our example, you would have a $20,000 loss, you reduce it by $500, it would be a $19,500 loss. Then you can deduct the entire amount, the entire $19,500, and you can do that even if you don't itemize. You don't have to itemize in order to deduct that amount. But again, that is only for certain disasters as declared by Congress. Unfortunately, they do not declare very many disasters as being a Stafford Act disaster. But if they do, then you get this larger deduction, and you can deduct it even if you don't itemize. Condemnations. So a condemnation is the legal taking of private property by a government body for public use without the owner's consent. This is a type of involuntary conversion like we already talked about. And any property that is sold under a threat of condemnation also qualifies as a condemnation. So this is the example you hear about where the government is building a new highway, and so they are condemning all the property that is in the way of that new highway. And so they are going to buy all those people out. Because when they do the condemnation, they don't just take the land. They have to give the people the fair market value of their land. So if you have a condemnation of your personal residence, then you generally can exclude the gain just as if you were selling your house. So you can exclude up to $250,000 or $500,000 if you are married filing jointly and if you meet all the rules. But a condemnation is an unforeseeable event that qualifies for partial exclusion. So remember, we said even if you don't meet the criteria, if you have an unforeseeable event, then you can have this partial exclusion. So a condemnation counts as one of those unforeseeable events. For any type of condemned property, so even if it's not your primary residence, you can postpone the gain, as we previously discussed, by buying a replacement property within the replacement period. And that is the last topic in video 3. In our next video, we will move on from income and talk about adjustments to income and deductions. So I will see you in video 4.